Hello, my name is Noella Auneau, founder of Trustful Bookkeeping, where we help consultants understand their number with clarity and confidence. Today we will talk about the difference between cash and accrual accounting. Here is a quick scenario. Tell me which month your business made money. It's October 15th, you finish a 6,000 coaching engagement, 3 months of intensive work, every deliverable complete, client is thrilled. You send the invoice, you contract say net 30, so they pay on November 15th. The money hits your account in November. So, did your business make that 6,000 in October or in November? If your answer was obviously November, that's when I got paid, you are using cash accounting. If your answer was October, that's when I earned it, you are using accrual accounting. And if you just said, I have no idea which one I am on, this video is exactly for you. You might be thinking, does it really matter? It's the same 6,000 is array, right? It matters more than you think, because here is what happens when you record the 6,000 in the wrong month. Let's say October was a slow delivery month for you. Lots of work, but nothing else was collecting. And November happened to be when 3 other invoices all come in at once. Under cash accounting, October looks like a disaster, and November looks like a record month. You panic in October, you celebrate in November. But in reality, your workload and your performance were completely consistent across both months. You were never struggling. Your book just couldn't tell you that. This is a core difference. Cash accounting tracks your bank account. Accrual accounting tracks your business reality. And where you are running a consulting or coaching practice, where retainers, upfront program payments, and net 30 invoices are the norm, understanding both is genuinely essential. Let me break down exactly how each method works, and then I will tell you which one makes sense for where you are right now. Let's go back to that 6,000 coaching engagement. You finished in October, but your client paid in November. Under cash accounting, the rule is simple. Money in, you're recording. Money out, you record it. Nothing else matters. So, in October, you work your tail off, delivered everything, sent the invoice, but nothing gets recorded. As far as your books are concerned, October was a zero revenue month for that client. November 15th arrives. The client pays. 6,000 hits your bank account. That's the moment you record the revenue. November, not October. Same logic applies to your expenses. Let's say, in October you also pay 800 for a video editing tool you use in your programs. You record that expense the day the charge hits your card, not when you decided to buy it, not when you first used it. The upside of cash accounting, it's simple, intuitive, and mirror your bank statement exactly. For a solo consultant just starting out, this is often all you need. But here is the problem. Your bank statement and your business performance are two completely different things. And when you start mixing retainers, upfront program payments, and invoices with payment terms, cash accounting starts giving you a distorted picture. Now let's read the exact same scenario through accrual accounting. Same 6,000 engagement, same October delivery date, same November payment date. Under accrual, the question isn't when did the money move? It's when did you earn it? You delivered the full engagement in October, that's when the revenue belongs. So, you books record 6,000 in October, even though not a single dollar had hit your bank account yet. That 6,000 shows up on your books at something called account receivable, money that's yours, that's been earned, but hasn't been collected yet. When November comes and your client pays, you are not recording new revenue. You are just converting account receivable into cash. Now, applying the same thing to your expenses. In October, you subscribe to a project management tool, 1,200 billed annually. Under accrual, you don't record 1,200 as an expense in October. You spread it 100 per month for 12 months, because that's when you are actually consuming the value. This is why accrual gives you a much more honest profit and loss. October's number actually reflect October activity, not just what happened to land in your bank that month. Let me show you what this looks like at a slightly bigger scale, because this is where the stakes get real. Meet Marcus. He's a leadership consultant. He has a solid practice, about 180,000 a year. In November, he does something smart. He pre-sells his entire first quarter mastermind. 8 coaches, 3,000 each, all paid up front. 24,000 lands in his account in November. He also delivered 2 consulting projects in November, 8,000 of work, but both clients are on net 30, so those invoices won't be paid until December. Now, watch what each accounting method tells Marcus his November look like. So, with the cash method, the revenue recording is 24,000, the mastermind payment collected. The 8,000 consulting work are not recording yet because the cash hasn't arrived. It will appear in December. Marcus thinks, oh, is an incredible month, is celebrating. If we take the accrual method, for November, the revenue recording is 8,000. The consulting work actually delivered. The 24,000 mastermind will be recorded as deferred revenue, a liability, not an income yet. Marcus sees a solid normal month. Here is where it gets dangerous for cash method. Marcus sees 24,000 in November and thinks he crushed it. He pays himself a big bonus, he hires a part-time assistant, he buys new equipment. Then January through March arrive. He's delivering the mastermind, 8 clients, week of intensive coaching, but no new cash is coming in for those months, because those clients already paid and he spent the money. But with the accrual accounting, he saw that 24,000 as a liability from day one. Money he owed in future services. He kept it set aside. He planned around it. He knew January through March would be delivery heavy months with lighter cash collection, and he managed accordingly. Same business, same revenue, completely different financial decision, and completely different outcomes. So, which one should you be using? Here is how I think about it for consultants and coaches specifically. Just starting out on the $75,000 a year, cash accounting is fine. Your revenue is probably simple, a few clients, straightforward invoices. Cash methods keeps your book clean and easy to manage yourself. Just make sure you are tracking which invoices are outstanding so you are not surprised when a slow payment month hits. Growing between $75,000 to $258,000 a year, this is where cash accounting starts lying to you. You are likely mixing upfront program sales, retainers, and project invoices, all with different payment timings. You should, at minimum, be running a monthly review through an accrual lens, even if your official books are still on cash. A good bookkeeper will help you to do both. Scaling to $250,000 plus or raising money, move to a full accrual accounting. Full stop. If you are ever going to bring on investors, applying for a business line of credit, or hire a team, your books need to reflect the real economic activity of your business. Accrual isn't optional at this stage. And here is the things nobody tells you. These two methods aren't mutually exclusive as a management tool. Your day-to-day cash flow decision, can I pay this contractor, can I afford this software? Those use cash thinking. Your strategic decision, how profitable am I really? Should I launch this new offer? Can I hire? Those need accrual thinking. The most financial sophisticated consultants and coaches I work with have internalized both lens. And typically a fractional CFO or experienced bookkeeper is the person who helps you build that picture. If you are a consultant looking for bookkeeping services or fractional CFO, do not hesitate to take an appointment. The link is in the description so we can see how we can support you. Have a nice rest of your day. See you on the next video. Bye.